you, thank you.
Thank you, Josh. Thank you for coming.
What an intro. Thank you.
I worked on it a lot.
Hi, Google.
All right. Well, before we get into further establishing all of these credentials of yours with Twitter and your books and CNBC, if you'll humor me, I wanted to get into. I hope you'll help me co-pilot a little infographic here. I don't know if you're familiar with this, but I think it will spark some topics of conversation, maybe some people for Q&A at the end of the show. So what this is a visualization for all of the world's markets, okay?
Okay.
And one square here at the top that's $100 billion. Okay, that's $100,000 million, right? If my math is correct. All right, so it goes through, and I don't want to spend too much time on this, but I do want to go through a few things here because I think it's interesting and it'll set up some good stuff. So here we have silver. The world silver is $17 billion. This chart, incidentally, was made by Jeff Desjardins, and I emailed him, and we have permission to go through it at this talk. So thank you very much, Jeff. And it was made maybe 6 months ago, but it's still roughly, we're
Probably hasn't changed that much.
Not too bad, not too much, right?
Maybe crypto's a little smaller.
Maybe, or maybe it's about the same
Right.
since it's gone up and down. But so there's crypto, okay. Roughly, Bitcoin there is about $100 billion or so, and you can see it's a certain size. And then as it goes through, this is next the largest companies in the world. We have Alphabet.
Congratulations on that.
Hey, thanks. We made the list.
I always knew you would, by the way.
Next, we have 50 richest people. Bezos is in there. I think he just hit $100 billion, if I'm not mistaken.
Probably most of this audience is in there.
Yeah, a couple of us are in there too, but we're not listed on the chart.
Well done.
As it goes down, there's a few things I do want to get to into more depth, but as we go down, we have California's GDP. Remember, every square, $100 billion. Fed's balance sheet is about $4.5 trillion. And as we move through, here's where I think it gets a little interesting. We have currency and gold. Both of these markets, roughly $7-8 trillion.
Yeah.
So just to get the crypto discussion out of the way or point out of the way, I think maybe in general the bull case is that these little dots here have room to grow if it's going to be some form of digital gold, right? Even if it's $1 trillion, people are hoping that grows. Whether that'll happen.
I am on the other side of that.
Okay.
So
you think?
Let's just go right in and break everyone's hearts.
That's great.
I bought Bitcoin last summer at about 2,300.
Okay.
And it ran to 19,000, and I didn't sell it because I got that argument that
right.
Maybe not what percentage of the gold market should Bitcoin be, but maybe I just thought about it as this is going to be a very important network for transactions. And then if the ownership of Bitcoin represents renting a piece of that network, then there would be some value there. And I did believe that, and not because the price went down, but I kept listening to podcasts. And if you listen to enough podcasts, you get so many opinions, and so maybe mine changed a little bit. I know it's a cliche to say you're bullish on blockchain technology, but not bullish on Bitcoin. But I actually now think that that's the most rational way to think about it all. And the blueprint for that is the fact that what Tim Berners-Lee built and all the protocols that we use for email and for internet connection, and they have no inherent value on their own. HTTP is not worth anything. However, it's worth everything. But the real money has been made by companies like Google that built the layer on top that actually makes it usable for the consumer. So if you think about blockchain as just another protocol, maybe a very powerful protocol, there's no guarantee that just because Fortune 500 companies start to adopt blockchain incorporated into their processes, that means that a coin, for some reason, has to go up in value. So I think a great example from my world is Vanguard. Vanguard manages, I think, like $4-point-something trillion. They're doing millions and millions of transactions every day. Those transactions at the mutual fund level require something called reconciliation, which is basically people in an office somewhere pushing paper back and forth or moving numbers around in databases. And if that work can instead be done by a distributed ledger where there is a record of the buys and sells, an outside person can't come in and change the numbers because everyone's got the same record, and it's global, then maybe there needs to be less people who are taking basis points in cost in the system. So maybe Vanguard shaves a half a basis point in the cost of running a mutual fund, and that doesn't sound like a lot of money, but it could be billions of dollars. There's no coin. You don't need a coin for any of that to happen. But there's a tremendous corporate cost savings. In the case of Vanguard, the shareholders own it, so it's not really a corporate. But if other corporations start to use blockchain and things like their supply chains, which they're all now talking about, that's fantastic. But that does not imply that a digital currency somewhere has to spike in value as a result of distributed ledger technology. So again, I know it's a cliche. I know people are saying that, and at conferences, but I actually think that the cliche in this case is apt.
Got it. So it's safe to say.
Sell all your stupid altcoins.
Sure. So you're saying that though blockchain technology could be as transformative as everyone may be saying, it doesn't mean that if you're holding on to one of these particular coins, even if it's Bitcoin or Ethereum or Litecoin, that you're going to get in on that action necessarily of the world being.
In other words, the story might be so unglamorous and so unsexy that the only place the benefit of blockchain shows up is in the earnings reports of very boring industrial companies that are moving things across the country and finding ways to keep records in a lower cost, more efficient way. And no one's going to be like partying on a yacht as a result of that. Like it's not going to be like a hot thing. Ooh, I got in on blockchain. It's like blockchain enabled us to save $10,000 a day in shipping costs at our loading dock.
Got it.
You know what I'm saying? Like, there's no rappers talking about that, So I think separating the two is, it doesn't mean that I think the coins have no value or that, that's like a whole other, that could be like 5 hours. That would sound like a 4 a.m. dorm room conversation.
Right.
If we went, we're not going to go there today.
That's why I said let's get that out of the way.
All
so
right.
I don't want this to be a Bitcoin talk, okay? But
Now I'll tell you what I think about Ripple.
All right.
All right, go ahead.
Yeah, I was like ready for it, but okay, no, let's move on. So there's gold, all right, around 7 trillion. So here we come to the stock markets, and what I find remarkable about this is just how the United States is well over a third of the entire global equities market. That's pretty wild to me.
So if you pop this chart 120 years ago, in the year 1900, Great Britain would be 25% of this. The United States, I think, would be maybe 15. Now, Great Britain, UK stock market is 6%. And the United States came from zero, essentially, to half the world. And there are a lot of implications embedded in that data, but just the fact that we've seen one country go from being so dominant in the world stock markets to shrinking to almost nothing, I think is remarkable. The other thing about this is that China would be much bigger if the local companies that can be traded only by locals were open to the world. But China's exchanges are not completely open. So there's some interesting nuance to where the data probably comes from.
Got it. What I find interesting is that, for a lot of people, they sort of feel like maybe the buck stops here or with real estate, but there are some other things to get into here. The global money supply, I believe this green is from earlier on in the chart. That's sort of physical currency there, and then you have narrow money, broad money. This is all the checking deposits, all the money basically, physical and non-physical in the world, looking at about, looks like, 90 trillion, 120 trillion or so. So that's interesting. But as we go here, this is what I wanted to get into. Here's debt. And it doesn't all fit on the screen here, but this is pretty big. 70
That's
trillion.
not all sovereign debt. That's like consumer debt.
Totally. It's all
corporate
debt in the world.
Sure.
That's right. But that is an eye-opener. And as I go down, this is the end part of the chart. This is I freaked out a little bit when I first saw this chart, because then I come down here to, pardon me, there is real estate. This reminds me of SimCity when I was in college. I don't know if anyone played that game, but there we have commercial real estate, agricultural real estate,
See,
and
for
industrial.
me, it's more like Minesweeper.
Minesweeper, that too.
Where are the bombs in that debt chart?
Totally. Okay, derivatives. This is the bananas part, all right? This says on here, Like, we don't know
All right,
exactly how big it is.
Say your thing, and then I know what you're going to say. Say your thing.
There's a low-end estimate, there's a high-end estimate, and the thing is you just scroll.
All right,
and
so
scroll.
So let me add
Talk
a
to me, Josh.
caveat.
All right.
That's notional derivatives.
Okay. I'm still scrolling. Okay.
Half of these boxes offset the other half.
Okay.
That's what a derivative is.
Okay.
It's a contract.
Right.
Both sides are hedging or betting. So notional makes something really big seem bigger than it is. But a lot of the derivatives that are here, there's another derivative in there that is the offsetting bet.
Understood.
So this is not like a one-way bet that everyone is making on one particular thing.
Right.
This is millions and millions of things with insurance companies hedging and investment people playing both sides and banks betting on both sides. So it's probably less scary than the amount of boxes implies.
I look at this as almost like the sports book at the casino. Is that right? Like
fair.
I'm betting that the game,
Fair.
taking the spread.
So probably the casino only for a portion of the people that are playing in these markets. A lot of the people that are playing in these markets, you think about a company like Cargill. It's an agricultural company. They have a lot of risk. If it's a bumper crop, prices will drop. If there's terrible weather, there won't be enough supply. And they've got to use commodity markets to hedge what their exposure is. You think about a bank doing business all over the world, like Citigroup. They've got currency exposure. They have corporate clients all over the world. So a lot of this stuff is really companies offloading risk rather than trying to take more risk. And then there are speculators in the market. So maybe the casino aspect of it is not quite as pronounced. The one thing the media has done with the term derivatives is they've added a connotation to it. It's kind of a loaded, derivatives.
Right.
That's code
They took us
for.
down.
That's code for I don't understand it, so it must be bad, or these somehow represent speculative bets. When in reality, a lot of it is attempting to minimize risks.
Got it.
Feel better?
I did a little bit. Thank you.
That's why I came today.
I did. Thanks for going through that with me and humoring me. I just hopefully that was eye-opening for some people. I'm going to move on now to you. Okay. I have a. I hope this isn't too personal of a question, but what dark past or VH1 behind the music story leads to you becoming the reformed broker? What's reformed?
So I did the book about it I wrote it in 2011, which was about a year post leaving the brokerage industry. But long story short, I come from this really strange place on the East Coast called Long Island. And in the mid to late 1990s, every aggressive young male got a Series 7 and became a broker. It's just like it's what you did. Like if you grew up in Nebraska, you became a football player and played, you were a Cornhusker. So for whatever reason, what we did was we became stockbrokers. And it was the golden age of being a stockbroker because it was pre-internet. It was pre-people having access to building their own portfolio. Charles Schwab was out there. You used to call Charles Schwab, and you would pay like $10 to get 15 stock quotes read to you over the phone. It's a true story. So people wanted access to the market, and the only way they could really get it was via a stockbroker. So there was some like glamour to being a broker, and there were high-end versions and low-end versions. And I was like kind of screwing around in college, didn't really have any serious passion to do anything. And my dad said, you should talk to my friend from the country club that I play golf with. I think he makes $1 million a day. Go get a job with him. My dad doesn't know, he doesn't know anything. So I meet the guy. He hires me 15 minutes later, which should have been a red flag. But I am studying for a Series 7, which is a very low barrier to entry that you need like a 60 IQ to pass the test. Also should have been a red flag. But I passed it. They handed me a telephone and they said, call these 500 people today. And I did. And out of the 500 people, 50 people would talk to you. Out of those 50 people, 10 of them would have money and would be interested in hearing from you again. You would call those people back a week later after you mailed them a brochure that had a sailboat on it, and you would sell them Callaway Golf IPO, Snapple is coming public. This is like 96, 97. So I was a cold caller, not able to sell stocks, but introducing a senior broker. My senior broker had 5 Porsches, one for each day of the week. And prior to being a broker, he was a bouncer. I mean, but like when you're like 20 or 21, you're like, all right, this is amazing. Like everyone's getting rich, the market keeps going up, and there were all these IPOs, and we're getting pieces of them, and we're helping people invest. And so I probably was really, really good at it. So nobody quits something they're good at, right? If you're good at something, you keep doing it. And all the nagging thoughts in the back of my head, like, am I qualified to be telling people how to invest? I don't think I am, but they're listening to me. So I did it, and then the financial crisis was a wake-up call, because everything I had done for people, and I did my best, sell them the right stock, mutual fund, whatever. But then you realize, you look back and you said, all I really did was sell people investments when I should have been advising them. So that was a great wake-up call, and I met my partner, Barry Ritholtz, because he was the guy writing the blogs. He started when you were posting on GeoCities, back when you would write for 30 minutes and then code for 30 minutes to get it published, 98, 99. But I met Barry, and Barry was telling the truth. And I said, I could totally do that. So I started the blog 10 years ago. Millions and millions of readers later, I'm still doing it pretty much every day, although not while I'm out here. But on a daily basis, I'm putting stuff out. And I'm like the worst nightmare for traditional Wall Street, because I know where all the bodies are buried. And I've spent much of the last 10 years, almost daily, talking about the ways in which traditional stock brokerage, hedge fund, et cetera, all the pitfalls, all the ways that people spend more than they should, people lose money, people are tricked, people are misdirected into investments that are not in their best interest. And I haven't made a lot of friends south of 14th Street in New York, but all over the country, people get what I'm saying, and they agree with it, and their enthusiasm for the truths that I've been telling have kind of kept me at it. And now I've broken into the mainstream financial media, which is an even worse nightmare, because all the advertisers are companies that I'm then saying, nah, you don't really need that. But they keep booking me, so I keep doing it.
Well, I definitely appreciate the candor you bring to the halftime report.
Thank you.
It's an awesome show, everyone on it, and I love what you do there. Can you tell me about, you started to talk about Ritholtz Wealth Management, like who are your customers? How does having 1 million Twitter followers and this blog you've worked on for so long, how does that fit into your business? Can you tell me anything else, like
so
assets
we
under
are
management?
we are the strangest version of our type of, our firm's called a Registered Investment Advisory. Everyone's heard the term RIA. Basically, we're non-brokerage, we're fiduciary only, managing money for high net worth households and small, pensions, endowments. And we're very strange in that most RIAs in the country, they look more like barbershops. It's usually a sole practitioner. Maybe he has a few people, or she has a few people working for him or her, but they're local. So they're like in the office complex that's on Main Street, or they might even have a storefront. And all the customers come because they play golf at the country club where all the other wealthy people in town play, and it's very familial and you could say incestuous. And these are relationships that are based on personality stuff and geography. They're not really based on this person's a really good investor. I think we've broken that mold. Most of our clients are nowhere near where we're based. We're based in New York. I think our biggest client base is on the West Coast, up from Portland all the way down to San Diego. And then we've got big pockets of clientele in places like Austin and Chicago, and a lot of clients we've not met, or we meet them 6 months into the relationship. We're already managing their money. They tend to be more progressive. A lot of people that work in technology. And what they all have in common is that they're not hung up on having the local office in town. They want the best people that there are. And if that's a telephone or a relationship on the web, they're okay with that. We bridge the gap by doing content. So Twitter, blogs. We have 5 of the top 20 independent financial advisor blogs in the country. 24/7, we're putting out our thoughts on markets, economics, the nexus of politics with investing, And our clients know where they can find what our thoughts are at all times. So we've built fans, and fans have become clients, and that is like the best way to build a business, I think, in the 21st century. And I think as people here are aware of, and maybe in finance, it's dawning on the industry, the scarce resource is not capital. You just showed me a slide. There's more capital out in the world than ever before. The scarce resource is attention. How do you get attention? Well, I'm not pretty enough to get a lot on Instagram, but you know,
right.
on the web and on Twitter, you can get attention by being helpful and by saying things that are true, maybe even things that are uncomfortable, but that have to be confronted. When you do a daily investment blog and you're giving people the data that they need to make smart decisions rather than emotional decisions, you can get a lot of positive attention for putting that stuff out there, not charging for it, not keeping it gated, and not acting like you invented the truth. You're just presenting people, here's the data, here's the evidence for why these types of investors do better than those types of investors. So if it's an attention economy and you're out there earning the right type of attention, you can build an amazing brand and you can build a fan base that become clients of your service. And when we started the firm less than 5 years ago, we were just under $90 million, 4 people managing it. We're 24 people less than 5 years later. We just broke $800 million under management.
Wow.
And we've opened offices in Chicago, in Newport Beach, California, Portland, Long Island, Florida. And we're talking to advisors all over the country that want to be part of this movement of evidence-based investing, putting the customer first. And all of this is happening as a result of digital. We don't take out newspaper ads. We don't, all of this is because of social media.
I would think that on certain days when maybe something big happens in the market, for better or worse, that it saves a couple of phone calls from happening if people can just go onto these other channels and see exactly what you think
That's
about
such a great point, and this was not intentional. We kind of figured this out along the way. Think about like if you have a wealth manager, and it's a good person, someone you trust, and then like on a Tuesday morning, think about an environment like, let's say 2011. You guys got to pay the bills.
I thought I had this not happen.
Think about an environment like 2011 where standard deviation for the S&P is off the charts. It's like 40, and the average annual standard deviation is 20. And 500-point swings in the Dow are happening multiple times a day. And news coming out of Europe is rattling U.S. stock markets, like, is Greece going to default on Friday? Stay tuned. I mean, that was like what was going on. And people with money at stake, people with investment capital at risk, do I have to pay attention to German Bund auctions? Like, is this where we are now? It's not that we have the answers to that stuff. I think we do a really good job with context. If your wealth manager is not in the office that day and you just want to like, you're reading like the app is buzzing on your phone, you're like, this sounds really scary. I hope my gal at XYZ firm, or I hope my guy at whatever firm is reading the same thing I'm reading, and I hope they have an answer to it. Our clients don't have to wonder if we're on top of this stuff and we're paying attention, because we are constantly linking to sources of information, telling people what not to pay attention to, pointing out people that are being hysterical and trying to scare the public for clicks. Not that we're like the police, but we're like, don't read this guy. He's a nut. He's been doing this every year for 20 years. And like that kind of thing, not just for fans, but for actual clients. I think that's the future of the industry. And I really think that financial advice is a communications business as much as it is a financial business, right? Because you could give somebody the best portfolio on earth, but if they can't stick with it, you did nothing for them. And so much of what we're doing with content is designed around, let's help people not do the wrong thing at the wrong time.
Awesome. I have to ask you about CNBC. Let's go there. And I have a photo of, the halftime report. But the thing is that I had.
Dude, I look jacked in that one.
You do.
I don't always look. Maybe I'm flexing. The guy on the other side of me played for the Chicago Bears, so he's definitely stronger than me. I'm stronger than Jim, though. I feel like, but Jim was on a submarine for like 8 years during the Cold War, some weird thing.
Oh, for real? I
All
didn't know
good,
that.
all good people on the network.
I had some other questions prepared, but I mean, I think the thing I have to ask you about, and here's my next slide, is Larry. I mean, you seem, I guess you were co-workers with this guy until just a few days ago.
Yeah.
Larry Kudlow is going to be...
I am next in line, by the way, when he gets fired.
I thought it was Kramer and then...
Kramer and then me.
Okay. So Larry Kudlow...
By the way, my partner Barry Ritholtz was on the Larry Kudlow show every week for like 3 years heading into the crisis. And Barry was the guy saying, this housing thing is totally unsustainable. All you have to look at is average incomes are doing this and home prices are doing that. So one of two things can happen. Either average incomes all of a sudden double nationally to justify what home prices have done, or there's some radical thing happens because an alien ship lands and hands everyone the money that they'll need to make their payments. And neither of those two things happened, so the third thing happened. But Barry was a frequent guest on Larry's show, and I've known Larry for, I think he's a fantastic guy. We are not on the same side of the political spectrum. I think he's a good guy. And I also think he's probably a better voice than some of the other voices that might get into the White House. So I'm really glad that he got the nod, and I hope he does good work on behalf of America. So that's my take on Larry.
Hope so too. Yeah, he.
Very nice man, and he loves the country. And even if you don't like his economic policies and you don't agree with tax or tariffs or whatever, he's like a good person, and I think he wants what's best for everyone. So.
You're probably the dozenth person that said that on television about him too. I mean, he seems like everyone says like, I don't agree. Not everyone that does, but everyone who doesn't agree with him says I have the utmost respect.
Well, listen, he's a hard, he's a free trade, cut tax. I mean, not everyone agrees with that, but no one that has met him personally, he doesn't have enemies. He has people that disagree with him on policy. There are legit guys out there that could be in that spot that have like enemies because they're bad people. So it's good that it's going to be Larry rather than someone dangerous. I guess is how I would say it. Now I disagree with a lot of the economic stuff, but everyone disagrees with everyone. So it's
Yeah, there's not a lot of screaming at each other on CNBC. Sometimes, but it's kind of not too much. It's nice to go to a channel and there's a more rational discourse. I have a few other. I'll just throw it back to this slide here. Before we move to the Q&A here in just a little bit, I have a couple other questions here. So who is the life of the party off camera at CNBC? I imagine there's a green room. Everyone's vaping. Like someone's got to be, David Faber, who is it?
Is that what you?
Yeah.
Everyone vaping what?
Tobacco. It's New York, right?
Much more Molly than vape. No. So John Najarian and his brother Pete are two of my favorite people that I've ever met. Both of them were in the NFL briefly, and then they transitioned to the options and futures markets in Chicago, which is where they learned finance. Did very well for themselves. Now they're options specialists, but. They are exactly what they act like on camera. They are off camera. Two of just the nicest, best people I've ever met. And, they're a generation or two older than me, and I've learned so much about how to be an entrepreneur, how to do media and be true to yourself. And these guys come on in ponytails. They look like wrestlers, but they are genuine, and that really stands out. And I think that's why fans of CNBC really like them and appreciate what they bring to the table. And they also, similar to Larry, they're people that everyone that's met them likes them. So when I look at them and I say, all right, I'm doing media, what is the right way to do it so that I can be taken seriously and be myself and not put on airs or act like I know everything or become pompous because I'm on financial TV. Those guys are really great models for that.
Nice. I think we're going to move to the Q&A portion of the program, if that's all right. This is fun, Josh.
Okay, what should I ask you?
You don't have to you can, well, we're going to open it to the audience. If you'd like to ask me something, but I have to throw this to you if you're going to ask a question.
What is that?
This is a microphone inside of a foam Google Square.
Okay.
And whoever catches it, if you want to ask a question, you just hold the microphone, and then when you ask your question, you throw it to the next person. Here it comes. Okay. Question for John.
So we talk into this? Oh.
Talk into it.
How you doing?
Crazy, I know.
Yes, sir. You with the box.
Oh, okay. Kind of an odd question. So I actually do a good amount of investing. I go out and raise capital and match deals in dollars. I spend a lot of time in real estate and look at the market a lot. And my question is, I started a REIT in 2010 when it was obvious that the opportunity was there. Today, it feels like we're much closer to the ceiling than we are the floor.
Yeah.
Which it kind of feels like in the market as well. And my question, which I know is a bit of a vague question, is what do you do when everything in your gut tells you that the risk isn't there with the reward?
Yeah.
Where do you go? How do you identify what the next thing to do is? Or do you just sit on capital waiting for the next 2010, maybe missing some more of the upside, but what I found was by having capital at that time, I was able to make a lot of money. While everybody was kind of running out of the building, we were running in.
Yeah, but
So
you had to have been liquid at that time. You
Correct.
couldn't have been fully invested and then taken advantage of the opportunity.
Understood. And it's not about necessarily, it's not really about knowing the exact ceiling and the exact floor. We happened to do it in 2010 on the real estate market. But what do you do when you start feeling like you're almost there?
So real estate is very different than like the stock market question, right? Because if you feel that way with real estate and you want to do something to prepare for the down cycle, you need like months and years in order to start liquidating properties. Like you can't just be like sell, you know.
Right.
Stock market is different. If you want to be tactical in the stock market, a portion of our client portfolios are. So like our investment beliefs, like just to give you like a little bit of background, and then I'll answer your question specifically. Our investment beliefs are that less is more. There are simple answers to complexities. Not every complexity needs to be met with more complexity. Cost matters. After-tax returns matter a lot more than what particular investment you buy. So we've got this overarching philosophy of let's not go in there and twiddle the knobs every day. Let's let markets do what they do, and let's build durable, rules-based portfolios where the rules are set in advance and we're not using our gut instincts for things like market timing. Now that works for, let's say, 80% of a client's assets, and then maybe 10 or 20% will manage more tactically. That will also be rules-based. But that's going to be a function of trend. And again, we don't have to do this with real estate. We're fortunate. We can do this with zero-cost treasury bond ETFs and near zero-cost equity ETFs. And we can say in an uptrend, we want to be fully invested. In a choppy market, we want to do as little trading as possible so as not to get whipsawed. And in a defined downtrend, and not a downtrend where I'm like, hey, that looks like a downtrend, but mathematically defined by the slope of what the index is doing on a monthly moving average basis, we want to have less exposure. Even if that means there's this cataclysmic event and then the market rebounds and we're forced to buy back in higher as a new uptrend, that's fine. We look at it as insurance. It's not an alpha strategy, what we're doing tactically. But by marrying strategic long-term investing with a tactical piece, I talked all about investor behavior. It's not lip service. It's literally what we do is manage the psychology of investors. So if what we need to do is limit how much equity exposure they have in a bear market, it's okay if Jack Bogle disagrees. I have to face investors. He doesn't. So it's nice to have, a grandiloquent kind of overarching philosophy of never do anything, just buy and close your eyes. But I'm in the business like 20 years. I know that's not real. So I think we've married the two approaches that we just saw. We just saw the Nobel Prize for Economics awarded to, for the first time ever, 3 economists at once. I forget the third guy, but importantly, Bob Shiller. He wins. His theories about bubbles and emotional cycles driven by emotion. He wins at the same time as Gene Fama, who says there are no bubbles and markets are perfectly efficient at all times. How could they both win and share the same prize? Our portfolio resembles that win. So we say in the strategic portion of your portfolio, the market's going to be right more than it's wrong. The market is smarter than we are. Just by saying the market is mostly efficient is not the same as saying the market's always right, but we want to do as little as possible because Gene Fama's math backs up the way the capital asset pricing model and how the markets work. But then part of us realize that there are bubbles, and there are cycles, and there are emotional moments, and the pendulum does swing too far. So that's why we marry those two approaches. So seeing those two gentlemen step up and win the Nobel Prize together perfectly aligns with how we manage money. It's perfectly intuitive to us. So the answer to your question is yes, you should sell.
Perfect.
No.
I'm out.
The answer to your question is how do you know? You do not know. You will not know. But you have to be willing to say, if I feel this way and I'm not rules-based, and it's real estate, not stocks, there's no moving average for a building, you have to be willing to say, I'm willing to forgo some upside, even if it takes 3 years, because I think I would have more regret, and remember, all of this is regret minimization. What would you regret more? Missing the next 20% up and cap rates keep exploding, or seeing a 20% downdraft and having no capital? It sounds like you already know your answer, so you should start to sell right now.
Perfect.
Like leave the room and
I'm
start
out.
selling.
Leave.
All right, throw
All right.
that box.
Who's next? Throw the box. Let's toss it back. All right.
So you were talking about the housing market earlier, and so we're kind of seeing now like the market is kind of getting just super high, housing and the stock market, and with the recent tax cut, and I know that the administration is pushing to roll back a lot of the regulation that was put in place, like Dodd-Frank and all of that.
Already
kind
in
of
progress.
Right.
Yeah.
How do you feel like, what's your take on that? Do you think that the banks have kind of learned their lesson, or do you think that greed will take the day again?
We'll blow up again, but it doesn't necessarily have to be centered around the banks. Like we've had plenty of financial crises where the banks were fringe actors. They weren't necessarily in the center of it. If you would have told me, September 08, Lehman Brothers becomes the largest bankruptcy in U.S. history. It's like $200 billion or whatever the number is, dwarfing anything that even comes close to that. Makes Enron look like a walk in the park. And then a month later, 2 months later, December, the Madoff stuff starts to come out. If you had told me in that moment, right, Bear, AIG, Washington Mutual, Wachovia, Merrill gets rescued, Lehman doesn't, Madoff, $50 billion ponds. If you had told me that within 10 years we would be rolling back financial, I would say, no way. What could possibly be going on that we would be anti-regulatory, like voting in people that want less regulation, right? Well, I'll tell you what could go on. How about a 9-year nonstop rally in stock prices? How about the too big to fail regulations that perversely caused the 4 biggest banks to get even bigger, right? How about free money all over the world as central banks essentially monetize debt? In Japan, they're not just buying bonds, they're buying stock ETFs. Japanese central bank is buying REITs. Like, how about that? Maybe that could cause the kind of environment where we're saying we need less regulation because everything's fine. So the good thing about Dodd-Frank and capital controls and Basel III, which is like the global agreement on how much leverage banks should take, the good thing about all that, perversely, is going to become a bad thing. The good thing is that banks have never had better balance sheets. Never. They have never been in better shape. You look at leverage ratios, you look at their ability to do pretty much anything they want and return capital to shareholders, big dividends, big buybacks. Never been better. So of course, now is a great time to loosen up the regulation. But we have not had a crisis in 10 years. So that's why that's the new mode. The other thing that's happened is I think the Republicans have done a really good job at convincing blue-collar workers that somehow removing restrictions on payday lenders is good for them. I don't know, it's very odd. But I think what they've been able to say to people is freedom is being infringed upon. The freedom to drill, an oil well in your backyard. The freedom to strip mine Yellowstone Park. Our freedoms are, and it worked. And not every regulation is a good regulation. And Dodd-Frank is, we call it Frankenstein. It's not great. It's not perfect. But the fact that they've been able to message the American public that by allowing those regulations, it's hurting them, and it resonated. So I'll see you in the next crisis. But the thing is, we would have one anyway. Like I can reel off 25 crises that have happened. It doesn't matter, high regulation, low regulation, because risk finds a way, and everyone's memory is wiped clean relatively quickly. So I don't think we can regulate financial crises out of existence.
Okay. Next question.
Yeah,
You just handed the box. You didn't throw it, but that's okay.
Okay, that's fine.
So let's move along.
I'll toss it later. Yeah, I'm interested in your take on the companies that don't use advice or news to make bets, they just use mathematics, and like Renaissance.
Yeah.
And a lot of the people who run those companies, they come from the same places a lot of us come from.
Yes.
Academic mathematics and computer science.
Yes.
And they're the most, as far as I understand, they're the most successful traders on Wall Street.
Yes,
And,
at the current moment, absolutely.
And so, but it's interesting because they don't care whether, Steve Jobs dies. They just trade according to formulas. And
Right.
I'm curious.
So if you walked up to an average person, like a savvy person, and you said, in 2011, I know for a fact that Steve Jobs is going to die in 30 days. Buy, sell, or hold Apple. What percentage of people would say buy Apple? 10%, maybe? Everyone would say, oh no, the magic man, And I would have said that, because I don't know anything. Apple was worth $300 billion when Jobs died. It's worth $1 trillion now, almost. So it's tripled under the chief operating officer as the new CEO. He's created more value than Steve Jobs did. Makes no sense. Completely counterintuitive. So an algorithm doesn't care who's the CEO. Now, that's not the same as saying that algorithms won't react to news, though. So many of the trading algorithms are, what they're really doing is scanning headlines. And they're looking for things like bomb, White House. And so there was a hacking attack on the 60 Minutes Twitter account, and said a bomb went off at the White House, and the stock market lost like 3% in minutes. Now, that's not humans reacting. It happened too fast. So those are trading algorithms that have specific keywords in their instructions. And they were fooled by a hacked Twitter account. So I don't know if machine trading hedge funds are quite as invincible as they might look at the moment. So we're talking about like Renaissance, which is Jim Simons, and it's an amazing story, and their returns are insane. No one even comes close, and they don't talk to Wall Street. They don't talk to analysts. They don't attend conferences. They definitely don't watch me on CNBC. They're PhDs running around and code breakers and non-traditional financial people trying to reverse engineer what drives markets and figure out micro profits on a minute-by-minute basis. The thing with that is that it's not novel. One of the best games ever, one of the best books ever written about investing is The Money Game. It was written in the 1960s, and there's a chapter with a computer that all the Wall Street people are in line. They want to put some information into it. Vonnegut wrote Player Piano, before, it's not a new thing. It's just a new version of it. And the reason why they won't be invincible is because anything that's got success, it will attract competition. And so now what you actually have going on is a quant arms race amongst hedge funds. Steve Cohen is hiring quants. Paul Tudor Jones is hiring quants. All of the big hedge funds are loading up their firms with data scientists, data analytics people, and they will nullify each other's edges. Like any other business, competition eventually arrives. So the thing with Renaissance, which has made them remarkable, is they didn't invent one algorithm and then live with it. They constantly are coming up with new ways. That's the only answer. It's a tough, arduous process. Most people won't be able to do it. And by the way, if you wanted to give them money, there's no 800 number. They don't want your money. And so they're an amazing success story. There aren't that many other companies that will come along and be able to replicate that.
Speaking of the algorithms, real quick, because there's another question, but I noticed a lot with...
Oh, wait. We're all waiting, by the way, on Wall Street for the Google hedge fund. That's rumored every 6 months or so. And you guys probably have more data about consumer activity, business queries. So once the Google hedge fund launches, maybe that'll do even better than Rentec. We'll see.
No comment.
No, I know.
What I was going to ask about, like when you see after hours, maybe an earnings report for a company happens, and it does seem like there may be certain keywords in their report, and you see like a tick down big time, and then it recovers right away. Is that basically keywords, algos dropping it, and then real people going in like, don't worry about it.
And
bye-bye.
And just saying it's a algo, that doesn't imply it's like a big firm with a really sophisticated. Like there are platforms now like Quantopian, and they are trying to democratize the use of data amongst regular investors. So there are people they call themselves prop traders. They used to call themselves day traders. Before that, they were the SOS bandits. But there have always been independent traders trying to build their own edge. And a lot of them have adopted a software that allows them to write programs. Doesn't mean they're sophisticated. Doesn't mean they're smart programs or they've done well. But yeah, there are absolutely moments where you look at a tick down or up in a security and you know it's a machine. You know that's not a person that's gone through even half of a cycle of a thought. So it happens every day. So long-term investors have it easy. They can ignore all of that.
Any other questions? Toss that box. Boom. We'll get you next.
Hi, Mr. Brown. What technology do you see, or what emerging firms do you see, if you have names, that you think may come and disrupt this financial markets, especially on the retail side, like for us, do it by ourselves?
So for do-it-yourself traders, so I think what software you use is going to be a function of how much time and attention you want to put into doing your own trading. So people ask me about Robinhood everywhere I go. It's the app that lets you trade stocks for free. And they've clearly built a big audience amongst millennials, and they've opened tons of accounts. Like, no one's making any money from that, really, which in this part of the cycle, that's okay. The investors, the people that back things like that, they want to see user growth. They don't really care what a user's worth yet. They figure, if you remember, we talked about the attention economy. Once we have scale and attention from a lot of people, we'll figure out a way to make money from that. So like maybe Robinhood feels pretty revolutionary in that they're allowing young people to open accounts, buy fractional shares. So a share of, how much is a share of Google right now? 1,200-ish. I own it. I don't look at every tick. So let's say it's 1,200. You know, can somebody doing their first stock transaction buy 100 shares at $1,200? Probably not. So the fact that they can buy 4 shares by entering in a dollar amount rather than entering in a share amount, it sounds weird. That sounds so simple. No one else did it until they came along. They said, why can you buy mutual funds in fractional shares but not individual stocks? So that feels like somewhat revolutionary. I don't know how profitable it is, but there's stuff like that for the retail investor. And then some of the algorithmic things. Every week there's a new one. I don't know that any of them have built a lot of traction because there aren't that many do-it-yourself investors who want to spend hours of their day building trading algorithms for themselves. I think it's a very small slice of the overall investor universe. So none really come to mind specifically that have captured a big amount of the market because the market is a narrow market to begin with.
Nice. I think we had one final question up here in the front. Got time for one more? Boom. Okay.
All right. Can you hear me?
Yep.
All right. Big fan of Halftime Report.
Thank you. I appreciate it.
No sweat. So just combining the kind of financial question with the media question, it's a highly opinionated show. Do they give you any specific instructions or cadence, or are you waiting for someone to tap you on the shoulder that said, hey, that comment was out of line, or any of the suits at NBC kind of give you any kind of frame of reference in terms of what is off limits?
Well, CNBC has a really big responsibility because if people say something on their air and it moves the price of an investment instrument, they want that thing that was said to have been true. And then each individual person that comes on the air, if they're an investor and not like just a TV personality, has their own compliance regulations to contend with. So I can't speak for everyone else, but I can tell you that I have to disclose all of my holdings, and during the show they pop it up. Josh owns these things. What they don't want people to do is say one thing but do the other thing. So they don't want people to come on and say, I love Target, and then be shorting the stock after it pops up, for obvious reasons. And I don't think there's a lot of that going on. It would be so counter to your interests if you're doing media on a regular basis to pull off one trade and try to make a couple of % on it. So I don't think a lot of that's going on. The other thing is we can't talk about stocks that are below a certain market cap. So they don't want us going on talking about a stock trading on the pink sheets that could double based on a mention on TV. So if you watch the show, most of what we're talking about are S&P 100 companies. We really can't move them with our remarks unless there's news breaking, but that wouldn't be coming from panelists like myself. That would be coming from the reporters. Separating who's a reporter and who's a commenter is important for the audience. Just like when you watch political news or sports news, there are some people who are stating a fact as a reporter, and then there are people who are commenting on the fact. And I think keeping those two things separate in your mind is probably the best thing you can do when you encounter any kind of news program, financial or otherwise.
That's a great question to end on. Thank you. I think we're out of time. Thank you very much, Josh.
Thank you so much, everyone. I appreciate it.
We appreciate you coming.